Yeah, so we're gonna jump into some derivative stuff now. October was quite an exciting month. We had the Bitcoin futures ETF approved by the SEC and launched on the 19th. So right here we just have CME Futures Open Interest. So you see that went from $3 billion at the top of the market in April to now when we release this report to 5.5 billion. And what we see is just a maturation of this space in U.S. capital markets, specifically with the CME leverage ratios are much smaller. You have to be 40 to 50%. You have to have 40 to 50% margin, so around 2x leverage on any Bitcoin positions, and you can't use Bitcoin as collateral, which may sound like a bad thing, but what it means is that actually from when traders are looking to long Bitcoin, when they're looking to bet on Bitcoin going up on CME futures, they have to use traditional forms of legacy collateral, not Bitcoin, which leads to less explosive liquidations and downturns. So from a price action standpoint, CME becoming a market leader in the Bitcoin futures and derivatives market is really good. And so we have a CME market share chart on the next chart, Sam. There actually may be a few more there. Yeah, so this is the CME futures open interest market share. So we don't have this displayed, but at the top of the market in April, what you saw was the leading open interest derivatives and futures exchanges were all Bitcoin margin. So basically, it was a bunch of traders were longing their longs. They were betting on Bitcoin to go up with Bitcoin, and obviously that led to a pretty bad outcome. It leaves the market pretty susceptible to massive liquidations. And so with CME as the market leader, and now around more or less 20% of the futures market open interest, we kind of see, I think from a derivative standpoint, we'll see less volatility, even though Bitcoin is still a very volatile asset. It's, the Bitcoin, the less Bitcoin margin, the less Bitcoin collateral in the derivatives market, the less downside volatility there will be. And for bulls, that should be a welcome sign. So here we have just the futures annualized rolling basis. So what you can think of this as is there's a spot Bitcoin price, and then there's a futures market price. And so any commodity, like traditional, just physical, tangible commodities, have a futures market, and so does Bitcoin. And so 1 month out, 3 months out, 6 months out, 12 months out, there's a price for Bitcoin in the futures market. And so this rolling basis is the spread between the futures market 3 months out and the spot price. And so if you take the difference between those two, usually the futures market is trading above the spot price, which is called a contango. And if you take that spread and you annualize it over a year, you'll get right now about a 14% rolling basis. And so this is a market neutral or risk-free in Bitcoin terms trade. You have no exposure to the upside or downside, yet you can get a 13.78 return, or you can get at the top of the market, you could have gotten a 45% return. So what does this mean, and why is it really important? Well, essentially in this the global macro environment, which we'll not dig into too deep here, but we cover it on the deep dive extensively. The global macro environment is essentially a zero yield world. There's interest rates are zero everywhere. Inflation's running high. It's impossible to get yield on anything. And so when this Bitcoin futures market, which is growing rapidly and is around $20 billion of open interest and growing on multiple jurisdictions around the planet, essentially this is an incentive to come into this market. And the higher this goes, the more incentive there is to enter the spot market, because to capture this yield, you have to buy spot Bitcoin and sell the futures contract. So the financialization of Bitcoin in this sense is actually bullish, because even if someone's agnostic to Bitcoin, have no interest in these markets, the yield is impossible to ignore from a financial incentive standpoint. So this in general is a good development. And this is why futures, even though they get a bad rap, derivatives, people might think it's a bad thing. It actually puts an incentive for capital allocators around the planet to have interest in this market, even if if their head's still in the sand. So this is kind of what we talked about earlier. This is just when I'm talking about Bitcoin margin or the CME and how you have to use legacy collateral. Well, in crypto markets, that is either stable coins, Tether, USDC, or actual just dollars. A lot of these derivative exchanges don't have fiat on ramps, but they have stable coins. And so this is essentially just a ratio or a percent open, the percent open interest that's Bitcoin margin. So it's in April, 70% of the market was using Bitcoin as margin or collateral for their derivatives, which means that to the downside. There's a lot of people that saw their positions decline, but also their collateral decline. So it's an explosive dynamic there, not good for bulls. And the lower this goes, the more that stable coins are used, and that's actually a bad thing for bears, because if you're shorting Bitcoin with stable coins, then you're going to have to cover. The higher Bitcoin goes, the more it's going to cost to cover your position. And so this is a good dynamic for bulls, and we'll be covering this extensively with a deep dive. Have been covering it all summer, but overall, this maturation of the derivatives market, the more stable coins in the ecosystem, is actually good news for bulls. And this is just so similar to what we covered just a second ago with that rolling basis. This is the 1 month. The other one was the 3 month. But here we kind of see this chart, and this is from August to October, and we see this 1 month basis. So it's November today, this month. Next month would be December. An example is I sell the December 2021 futures and I buy Bitcoin, and I can capture this spread. And so for the longest, for over the summer and for the months leading up to October, there was basically like a 0 to 5 or 6% return, or annualized return, between the spot and the futures price. But as rumors started to swirl around with the futures ETF, we saw this premium jack up. We saw this basis jack up in a huge way. As a bunch of people started to buy CME futures. And so, I tend to believe that this was traders front running an announcement. And that the smart money knew that something was imminent, and, it turned out to be right. And so, we saw that basis hike up just to 24% the day after the futures ETF was launched. And it's, since drew down a little bit, but, the institutional capital that's bidding up these futures, it is a good news for the spot price as it incentivizes more capital to flow into Bitcoin.
Yeah, it'd be really interesting to see where the kind of contango spread, the basis spread, ends up with kind of this extra futures ETF demand. I know it's over $1.1 billion in assets under management now, I think, if you're looking at FIDO and VFD. So I think we're just getting started to see kind of the impact of what futures over the next few months is going to have on this type of spread. And it really does bring in a lot of outside capital from people, like you said, that are agnostic to Bitcoin.
Yep.